Good morning, students. Welcome back to the session on Indians. Today we are going to continue with our discussion on business combinations briefly because in the last session we started with one illustration and some part of it was pending. So we'll discuss that, and after that we'll start with our discussion on consolidated financial statements. That is about consolidation and the related concepts. Okay, yeah. So moving back to the illustration, if you can just all of you go back and confirm whether you have been able to prepare the balance sheet or not. In the last session, the illustration that we picked up, we covered everything except the preparation of the balance sheet. Can you please go back to that illustration, please? Illustration number 40. Yeah. Illustration number 40. Page 13.102, illustration 40. In this question, we discussed about the computation of goodwill or capital reserve. So we were getting capital reserve over here. There was also a fair valuation of some assets which resulted in that capital reserve. Then we also discussed in detail with certain adjustments about the computation of purchase consideration. Yeah, you remember the adjustments which were there, which included deferred consideration as well as contingent consideration. Correct? Yeah. There were also certain adjustments related to employee benefits. There were certain adjustments related to ESOPs, or I should say share-based payments. So all of those adjustments we had discussed. Now it comes to the preparation of the balance sheet. So can you quickly confirm whether you have been able to prepare the balance sheet or not? That was also a homework for all of you. I'm waiting for a response. Can you please confirm this quickly? Homework is all done. Have you been able to prepare the balance sheet or not? Yes, quickly confirm this, huh? Balance sheet is all prepared. Tell me. So should we start with the balance sheet then? Yeah. If you have been able to prepare the balance sheet, please confirm. Yeah. Okay. So now coming back to the balance sheet. So when we talk about the balance sheet, it's about the consolidated balance sheet. So consolidated balance sheet will mean that we will have to prepare the balance sheet of P Limited and D Limited on a combined basis. And this balance sheet is required to be prepared on the date of acquisition. What was the date of acquisition? 1st April 2000 X2. Yeah. Now, on this date, when you prepare the balance sheet of combined entities, or you can say of this group. Now, basically, this group comprises of two entities. So this should include the numbers of P Limited. Why? Because P Limited is acquiring D Limited. D is Dynamic Limited. Plus, this should also include the numbers of Dynamic Limited, but the numbers means the financial numbers of amounts of assets and liabilities. The numbers of D Limited, which will get included in the consolidated balance sheet, will be the one at which acquisition has happened. Yeah, all of those figures are available to us because we have considered all of those figures while computing the capital reserve. Correct? Yeah. And needless to mention that all the adjustments which arose during the computation of capital reserve will also have to be incorporated in the consolidated balance sheet. Correct? This was also the main part of this question because this question primarily required preparation of opening consolidated balance sheet. So till the time this is not done, solution is not completed. Okay, for which I suggested that whenever you start this in the exam, you should have some space, because this will become your main answer and all the remaining things will become your working notes. Correct? Yeah. Now, before we move further, we can just again go back to one more working note in respect of preparation of consolidated balance sheet of both these companies. In the meantime, I have this response from Pujita. Pujita has completed this, and I'm sure many others would have completed this. But anyways, we should also do this balance sheet first. Now, when it comes to preparation of the consolidated balance sheet, we can just combine these numbers by putting down these adjustments. This also happens to be the working note number 3 in the study material. So I'm just using the same thing for our purposes also. Okay. Yeah. For our purposes, I'm using the same thing. Now, unlike what has been done in the study material, what you should also do is whenever you prepare the consolidated balance sheet, you should always use notes as we discussed, because whenever any balance sheet, P&L, anything will be prepared, that has to be as per Schedule 3 format, for which you should have notes, and those notes should include all of those workings. So you can also in a way consider that these are nothing but those notes. Okay, clear? Yeah. So for the time being, I am moving on to these notes again because of the space constraint, and finally on the basis of this, balance sheet will be ready for you. Correct? Yeah. So now the first adjustment which will be required in respect of balance sheet will be items of PP, because in case of PP there was an adjustment. Correct? So what we can do is, so we can say computation of consolidated amounts of consolidated balance sheet. Okay, and in this case we have first of all various particulars. We have particulars, then we have two companies, P Limited, D Limited. Then we have P Limited, D Limited, and then of course the adjustment and the total amount. Now we'll start with assets, and in terms of assets, we will be starting with non-current assets, which includes PPE first of all. Now PPE in the books of Professional Limited is given to us, so we'll pick up the number as it is. It's 300. In the books of D Limited, it's 500. But fair valuation of 500 has become 150. Sorry, 350. So we'll have to cut down this number. So one adjustment will come, because of which this amount should go down, because this should become 350. Okay, yeah. And what do we call this adjustment as? We can say this is adjustment due to PPA. So it's all about preparation of consolidated balance sheet, which anyways we are going to pick up next. Okay. So all in all, this will become 650. Next adjustment, investments. Now investment is the amount which is straightforward. So this is 400 for P and 100 for this. No adjustment is there. So it becomes 500. Next item is what? Current assets. We start with inventories. So we have inventories. Now on inventories, there was no adjustment due to PPA. So it's 250 for P and 150 for D. 150 for D, no adjustment, so it becomes 400. Yeah. Then we have some financial assets. And these have not been put in the form of Schedule 3 format. These are all adjustments which are coming in one by one. So we have trade receivables, 450 and 300. Once again, no adjustment is there. Excuse me. Excuse me. So this will become 750. Then the next amount is for cash and cash equivalents. Once again, there is no adjustment is there. Cash and cash equivalents is 200 and 100. 200, 100. So it's 300 in totality. Then we have others. Others is the remaining assets. Please remember the basis of all of these assets is the balance sheet which is available in the question. Okay. On others, we have 400 for this, 230 for this, no adjustment for this, and this is 630. So we can also put the total over here. This becomes 2000. This becomes 1380. This is 150 in totality, and the total means the consolidated amount of assets comes out to be 3230. You can also confirm if your number matches with this. Okay, yeah, fine. So with this, we are done with the part related to assets. Now, alongside, what you can also do is, alongside, you can go to the balance sheet, the main balance sheet, which is required to be prepared. So this is only a kind of working which we have done, but the balance sheet will not be presented like this. The balance sheet will not have these three columns. Balance sheet will only have these two amounts. Okay, which you can present appropriately. Clear? Clear on this? Now, we will go to the next part of the balance sheet, and that is about equity and liabilities, wherein we had various other adjustments. So I'll have to clear this part. Fine. Okay, moving on to the next part, that is about equity and liability. So we'll start with equity. Okay, now on the equity, what do we have? First of all, it will be the share capital of P Limited. It will be the share capital of P Limited, correct? For D Limited, there will not be any share capital. Why? Because it's sort of now merged with P Limited. So its share capital goes off. It's already adjusted. So the share capital of P Limited was 500. Equity share capital of P Limited was 500. This is one. Other than this, shares were also allotted during the year, or you can say on this particular day, which was towards acquisition of D Limited. So the shares which were issued were 810. Additional share capital, or we can say shares issued to D Limited, which is what? 2 lakh into 10 into 70%. This was the additional share capital, 810. Fine. 810. Just 1 minute. Let me just also. I think I put the wrong number over here. So let me just compute this quickly. So it's 2 lakh into 70% into 10. So it comes out to 40. Sorry, I put this earlier over here. This will be coming over there in terms of adjustment. This is coming due to adjustment only. So this will go to adjustment. Earlier I showed it over here. This is 14, but this will not go here. This will go to adjustment. Why? Because this is coming due to PP only. In this case of adjustment, you can also say that this adjustment is nothing but the PP exercise which is taking place. Okay. Next was in respect of equity. That means the other equity part. So if you can go to the balance sheet which is available in the question, you will get to see there is some other equity component for both these companies. For P, it is 810. For P, it is 810. What is other equity? It's a kind of reserve. For D, it is appearing at 225. But now because it's an acquisition, so this 225 will get adjusted. This 225 will get adjusted. Okay. Now this 225 will not appear. Now the adjusted number will have to appear. And what is that adjusted number? So let me just check this other equity amount. Let me just check this other equity amount. So this comes out to 318.62. Sorry, this is again not for this. This is the adjustment. 318.62. So the total becomes 1128.62. Next is on the replacement award. Share-based payment, or we can say replacement award, where again there was an adjustment. This adjustment was for 2.5, if you remember. So we will take this adjustment of 2.5 over here. Fine. Then there was securities premium. These shares were issued at a premium. So that security premium will come separately. So the security premium will come. For P Limited, there was no security premium. It has arisen due to allocation only. So we'll take this security premium once again to the adjustment. 42. Then we have capital reserve, which once again arose due to adjustments only. Means the PP exercise only. 274.12. So this 40 will go there, 274.12 will go there. Then we also got NCI because the acquisition was only 70%. So NCI is new adjustment, which is again coming because of PP. So NCI, it's not there, it's not there. Only because of PPA it has come. It is 154.95. Okay. Now the next adjustment is because of various other various other liabilities which are currently not seen over here. So let me just take those liabilities now one by one. So I am actually done with the equity part. So what I am doing is I am clearing this equity for the time being. Okay, yeah. The totals are not yet completed, but for the purposes of putting down entire thing, I'll have to clear this part. Huh? So on the equity and liabilities part, equity is done. Equity is done. Now we'll move on to various liabilities. So we'll start with non-current liabilities. Okay, non-current liabilities. So on the non-current liabilities, first of all, we have financial liabilities in the form of long-term borrowings. Long-term borrowings. For P, it is 250. For D, it is 200. No adjustment is there. So this is 450. Okay. Then we have long-term provisions. Long-term provision is what? 50 and 70. And in this case, once again, we had an adjustment of 28.93. Now, all of these adjustments you can check. All of these adjustments you can check in our previous workings, please. 28.93. So what do we get? We get 148.93. Then we also got deferred tax for PPA. So we had 40, we had 35, but deferred tax due to PPA was computed by us equivalent to 46.5. And this was deferred tax negative. Negative means asset. So that's why from the liability, this will be set off. So this remains as 28.5. Then we'll pick up all the current liabilities. On the current liabilities, what do we have? Once again, financial liabilities, which is about short-term borrowing. This is 150 without any adjustment. 100 and 150 without any adjustment. So we get 250. This is one. Then we have trade payable. Trade payable is 250 and 300. So there was no adjustment over here. So this will be 550. Okay. Then we had liability for lawsuit. Now this was a contingent liability, but we'll not call it as a contingent liability now because this gets recorded over here. And this came because of PPA 5. So this will become 5. Now, if we take the total of all the components of equity which I have cleared on the board, plus all of these liabilities, this should match with all the assets, correct? Yeah. So what do we get? We get this one as 2000, this one as 2000, this one as 755, this one as 475, and this should actually match with your balance sheet assets too. 3230. Okay. Yeah. All of you clear on this? Any questions, any doubts in case you have on this, please let me know. Yeah, done. So with this, we are also done on this illustration. Balance sheet is all done, but now the final balance sheet you can just present separately on your own, because it's all about putting the total figures with the relevant heads. Okay, yeah. So with this, we are done. Now, before I move further, let me just pick up some of the gap differences for the purposes of our understanding and for the purposes of kind of recap of this entire business combination. And we also understand that there are certain carve-outs. What are carve-outs? Carve-outs means the difference between IFRS and Ind AS. So for this, I would suggest if you can go to page number, just 1 minute. If you can go to page number 13.84. And then we'll have 13.108. Okay, currently we are starting with 13.84. So we'll just quickly go through these gap differences because at times these may also be asked. So you should anyways be aware of all of these gap differences. These are important. So we cannot ignore them. Yeah, so that's the point. First of all, in terms of the guidance which is available under Indian GAAP and under Ind AS, the guidance under Indian GAAP doesn't cover various type of combinations, means the coverage in respect of accounting requirement as per Ind AS 103 is significantly higher as compared to what AS 14 suggests, because AS 14 only applies on amalgamations, nothing beyond that, whereas Ind AS is not limited to amalgamation. Ind AS covers all the types of combinations wherever business gets involved. Correct? Yeah. Secondly, if you look at the method of accounting, which is available under Indian GAAP, it basically requires two types of accounting treatments. One which is called as accounting in the nature of purchase, and second which is called as accounting in the nature of merger. So these two are the methods which are followed. But do we have these methods under Ind AS? No. We only have one method, that is called as method of considering all the assets and liabilities of the acquiree at fair value with certain exceptions, except in case of common control business combinations, wherein we apply pooling of interest method. That means we pick up the assets and liabilities at book value. Okay, yeah. Now, when it comes to asset acquisition, once again, the guidance for asset acquisition is available under Ind AS 103 in terms of differentiating it from business combinations. Now, whether you go to Indian GAAP or you come to Ind AS, these are largely same. Means the guidance in respect of asset acquisition. Acquisition related costs. Under Ind AS, how do we treat them? These are expense now. Whereas under Indian GAAP, there is no specific guidance on this. And they are generally capitalized in the absence of any specific guidance. Now, if you talk about goodwill or capital reserve, the way they are computed. So now certain adjustments are required for computation of goodwill or capital reserve, as we know. And those also vary significantly. For example, if we talk about goodwill, for computing goodwill, we need purchase consideration. Purchase consideration may have various components, correct? All of which are required to be considered at fair value. Assets and liabilities are required to be considered at fair value with certain exceptions. Intangible assets are required to be identified and fair valued. Deferred tax adjustments are also required on all of these assets and liabilities except on goodwill. And then we get the amount of goodwill. Now, if we go back to AS 14, do we have all of these adjustments similar to Ind AS? Not at all. I'm talking about the computation of goodwill only. Second scenario, wherein we may say there are differences could be in respect of capital reserve. Do we also get capital reserve under AS 14 under Indian GAAP? But the treatment of capital reserve, or you can say the accounting of bargain purchase, is different under Ind AS as compared to Indian GAAP. How? First, under Indian GAAP, capital reserve, or you can say a sort of a situation sort of bargain purchase goes straight to capital reserve. But under Ind AS, what do? We reaffirm, we recheck whether it should be a bargain purchase or not. Only when we say that it's reconfirmed, then we take it to OCI and then move to capital reserve. Otherwise, we move it to capital reserve straight away. This is again a difference between Indian GAAP and Ind AS. Correct? Now the goodwill which we get under Ind AS is not amortized. We don't amortize that goodwill. That is only tested for impairment. Unlike what we do under Indian GAAP. Under Indian GAAP, amortization of goodwill is permitted. However, a period is defined up to which it should generally be amortized, and beyond that, if it goes, then it requires impairment testing. But under Ind AS, we don't amortize goodwill. Contingent consideration is another area which we see and which we have discussed, on the basis of which again goodwill is computed, which is different in case of Indian GAAP. In process research and development. Now, whenever we acquire any business, and with the acquisition of that business, some research and development which has been going on by the acquiring, that will also get acquired. Correct? That will also get acquired. Now, when that gets acquired, that is also required to be measured at fair value. But under Indian GAAP, we don't have any specific guidance on this point. Okay. Measurement period. You remember what was the measurement period? All of you remember? Measurement period was the period over which purchase price allocation can be completed. Acquisition accounting can be completed because some of the information may not be available. It may not be reasonably possible to have all of that information by the time financial statements of the year in which acquisition is completed are available. Yeah, and there should be general reasons for this. And that period happens to be 1 year from the date of acquisition. But there's no specific guidance under Indian GAAP in respect of this. Yeah. Business combination which is achieved in stages means the step acquisition. Now, when it comes to the step acquisition, if there is any previously held equity interest, what do? We consider that component for the consideration of goodwill or capital reserve. at fair values, those amounts are required to be considered. Under Indian GAAP, what do we do? If two or more investments are made over a period of time, equity of the subsidiary at the date of investment is generally determined on a step-by-step basis, which is not the case under Ind AS, wherein it is computed only when the acquirer will get control. Correct? Next, when the transactions are between common control, as we discussed, this also happens to be a carve-out. Carve-out means, so this first part that we have discussed is about gap differences, means Indian GAAP versus Ind AS. This is the first part. Okay. Second is one thing that gap differences, IFRS and Ind AS, means the difference between these two. These are also termed as carve-outs or a carve-out. Now, on this common control transaction, once again, we understand how the accounting is done under Ind AS, for which no specific guidance is available. But if you go to IFRS, IFRS also doesn't provide any guidance on this. IFRS doesn't provide any guidance on this. And that's why this also happens to be a carve-out. Yeah. As per Ind AS 103, a guidance has been specifically included, but under IFRS 3, it is excluded from its scope. Any business combination under common control is excluded from its scope. So that's why we can say it's a sort of carve-out. If you look at the study material, it's been mentioned as carve-in. Carve-in is in respect of some of the guidances which have only been included in Ind AS, but which are not there under IFRS. But anyways, there is a gap difference. So this is once again a gap difference. Another difference, if you remember, we talked about it. That was in respect of negative goodwill. Under IFRS, whenever there is bargain purchase, what do we get? Negative goodwill. Under Ind AS, we call negative goodwill by capital reserve. The terminology that is assigned to negative goodwill is capital reserve. But under IFRS, we do not have any capital reserve. Negative goodwill is called as negative goodwill only. Secondly, the moment we call negative goodwill by capital reserve, what does it mean? We are actually taking it to a reserve. But under IFRS, we don't take it to reserve. Negative goodwill goes to P&L straight away. Okay? Yeah? Understood? These are the gap differences between IFRS and Ind AS. For your purposes, you should understand all of these points. All right, clear on this? Now a suggestion from my side before we move further. If you go to page number 13.109, if you go to this page, there are various practice questions available. Can you see this? Yeah, various questions are available for your practice. I would strongly recommend you to solve all of these questions on your own. All right. You may be thinking, but sir, these are too many. The more and more questions you solve and all the questions of study material, particularly, the better you become, and it will be great for you in terms of your preparation for the exam. Because in the examination, you'll see about control that is transitory in nature. I have not understood this. Okay, so let me just explain you this point before we move further. See, control should not be transitory in nature, is in respect of common control. So say this is the structure. A holds 100% shares, 100% shares. This holds 100% shares, 100% shares. Okay, this is how the structure is set. Now, D moves from C to B. Let's suppose this has been the revision. Okay, yeah, Anjali, if you are there. Now, before the acquisition of D by B, now who has acquired D? B has acquired D. Earlier, it was under C. Before the acquisition of D, A was controlling D. Means the ultimate control was with A. And after its acquisition by B, who is ultimately controlling D? It's A once again. In both the cases, it's A. Correct? Now, this situation is called as common control, provided control by A should not be transitory. Means it should not be for a small period of time. It should be for a period of time which is long term, wherein A should continue to hold D for a long period. And prior to this acquisition also, A should have been holding D for a decent period. Yeah, this is something which we call as not transitory. It should not be transitory. That's the understanding. Clear? Now we can move on to Ind AS 110. And for Ind AS 110, you can please refer to page number 14.2. There's a chart which is available on this page. Can you all please go to this chart? This chart lays out various components of consolidation that we plan to cover. Though in this chart, the understanding which has been made available to you is in respect of various units as to which unit covers what. We are not going to focus on which unit will cover what. We are going to focus on the conceptual understanding of consolidated and separate financial statements. Okay. And along with this, You should also keep referring to page number 14.5. So there's a chart over here and there are definitions over here. First of all, we will understand various terms which have been used under consolidated financial statements. Okay. And then we'll begin with the next part. Now, when it comes to consolidated financial statements, it means more than one entities are involved which are required to be consolidated. The last example on business combination that we have covered was also a case of consolidation. Okay. Now let's try to understand this part. In the last example of business combination, Professional Limited acquired Dynamic Limited. So P Limited acquired D Limited. When did this acquisition take place? 1st of April, if you remember. Yeah. On this date, when the acquisition took place, the accounting which is done by P Limited, that accounting is called as acquisition accounting. Though we have discussed this part earlier, but I'm still repeating this for the purposes of your reference only. Now, after this, what will happen? After this, D Limited will become subsidiary of P Limited, and therefore, every time P Limited will prepare its financial statements on a standalone basis, P Limited will also be required to prepare its financial statements on a consolidated basis. So that means P Limited will not only prepare standalone, it will also prepare another set of financial statements. So one will be standalone and second will be consolidated. Means now every time P will be required to prepare two sets of financial statements. In the standalone. Standalone means standing alone. Standing alone means it has to be only one person. Which means standalone financial statements will be only for P Limited. And consolidated means it has to be more than one. So consolidated in this case will mean P Limited plus D Limited. Okay. Let us suppose acquisition date was 1st June. So this is 1st of April and this is 31st March 2021. Let's suppose acquisition by P Limited of D Limited took place on 1st of June. Now in this case, P Limited will prepare consolidated financial statements after considering or after adding up all the amounts of D Limited starting from this date. So the consolidated financial statements, CFS, this one, will be starting from which date? 1st of June till 31st March. Okay. And why is this so? Because prior to that, P Limited did not have any subsidiary, did not have any other group company which was required to be consolidated. but standalone will be prepared from 1st of April to 31st of March. And why is this so? Because standalone means this entity P Limited always existed on 1st of April. So if it existed on 1st of April, when should it prepare its financial statements from? 1st of April till the end of the year. Okay. And in this case, you may be thinking, but sir, will this not be a mismatch? Because P Limited is preparing its standalone for full year, means for 12 months, but consolidated for 9 months. There's no mismatch. And there's no matching that is required to be done. See, accounting is all based on transaction. When the transaction has taken place on 1st of June, when do we start consolidation? We'll start consolidation on this date only. It cannot be prior to this. Correct? Clear? Okay. Number 2, in terms of the same aspect of consolidation, it may happen, or in fact, in the given example, what we are considering is that D Limited also continues. So D Limited is not merged. Its 100% shares have been acquired by P Limited. Now, what will P Limited do? P Limited will prepare 2 sets of financial statements. We have talked about it. And what about D Limited? D Limited as a company has not lost its existence. It still continues to be there. In the 3 months up to, for the 2 months, these are 2 months because this is 1st June. For the 2 months up to 1st of June, D Limited was owned by some other shareholder, and after 1st of June, it was owned by P Limited. But was this company in existence for the full year or not? Yes, of course. So should this company prepare its standalone financial statements or not? Of course, yes. Each and every company is required to prepare its standalone financial statements, which D Limited will also be required to do. Okay. Now, because it will be required to prepare its standalone financial statements, so what period do we consider here? Should we say that D Limited should prepare its standalone financial statements from 1st of June to 31st March? The answer is no. Its standalone financial statements will be for 12 months only. These will be for 12 months only. Similar to what P would have done. And these will be for 10 months. Yeah. Clear? All of you? Yeah. Let's suppose instead of acquiring D Limited, now this is a question for all of you. Let's suppose instead of acquiring D Limited, P Limited created a wholly owned subsidiary on 1st of June 2020. Okay. P Limited created a wholly owned subsidiary on 1st of June 2020. So a company was incorporated on 1st of June 2020. Now, can you tell me for what periods standalone of P Limited will be prepared, consolidated of P Limited will be prepared, and standalone of D Limited will be prepared. Yeah, so can you now, on the basis of your understanding, confirm these periods to me? Quickly. I'm waiting for a response now. Yes, quickly. Over to you. Yes, quickly. Can you now tell me in this situation, what will be the period of three financial statements? Standalone of P, consolidated of P, and standalone of D. Ambika is saying, sir, now the standalone of D will be from 1st of June to 31st of March. And what about these two? Can you tell me? What about these two? Will they remain same or will they change? Ambika is saying consolidated will be from 1st of June till 31st of March. Kaustav is saying the standalone of P will be from 1st of April only, means it doesn't change. Standalone of D will be from 1st of June and consolidated will be from 1st of June. Very good. And now I'm hoping that you know this. Why has this been done like this? Because when the company D was not into existence, can it prepare its financial statements from 1st of April? Not at all. When the company came into existence from 1st of June, from which date will it prepare its financial statements? From 1st June only. Correct? Clear on this? All of you? Yeah? And same is the response from Pujita. Very good. Yeah? Anjali has also given the same response. Though Anjali is saying for D Limited, it should be 12 months. I think that is the part you need to just revisit. Huh? Okay, clear? Now, while we discussed all of these terms, there is one important term which you need to know. That is called as separate financial statements. Many of you would be aware of this, but still, because this term will be repeatedly used. So let's understand the meaning of separate financial statements. Separate financial statements are those financial statements which are presented by a parent, that is an investor who has control over a subsidiary, or an investor with joint control, or an investor who has got associate, means who has got significant influence in investing, in which the investments are accounted for at cost or in accordance with Ind AS 109. So what does it mean? See, whenever P has got any subsidiary like this, any JV or any associate, in such a case, this holding company or this parent or this company P Limited will prepare its standalone financial statements, something which we discussed. These standalone financial statements are technically termed as separate financial statements. Okay. These are technically termed as separate financial statements. Clear? Clear on the meaning of separate financial statements? Conceptually, whatever you understand about standalone is same in case of separate. It's a term which has been given. Okay. And in case P doesn't have any subsidiary, any JV, any associate, then it will always prepare standalone only or separate only. It will never be preparing consolidated. In that case, we will not term those standalone as separate. We'll term those standalone financial statement as standalone only. Clear? All of you? About the meaning of this term? Okay, I think Anjali had some confusion around the existence of this delimited. She's now clear. Great. So with this, we have broadly understood the requirements of the time periods in terms of starting the consolidation after the acquisition or after floating a subsidiary or say floating a company. Let us now try to understand the interplay of various standards in respect of consolidation. Interplay means the linkage, or you can say a flow of various standards for which various principles of consolidation will have to be understood. So for this, you can go to page number 14.4 now. There's a flow chart which you can refer over there. There's a flow chart which you can refer over there. Yeah. We can say a kind of hierarchy is required to be followed. In the hierarchy, holding and subsidiary comes first of all. Now, what does it mean? Say P Limited acquired D Limited. And because of this acquisition, P Limited got control over D Limited. So I'm not saying what is the percentage which P Limited acquired in respect of D Limited, because now we should ignore using such terms because those may be loose terms, because now we are actually into consolidation. The moment P Limited gets control over D Limited, D Limited will be called as subsidiary of P, and P Limited will become holding company for D. Okay. Now in this case, P is also an investor. P is also an investor. And D is also an investee. Because investor has invested into this investee. So we are saying the moment investor gets control over investee, that investee will be known by subsidiary. And investor will become holding for that investee. And in this case, for the purposes of assessment of control, the relevant standard will be Ind AS 110. Okay. Now the other point is whether this control is by P only or there are two more persons who are having control over D. So we are saying only one person, only one entity has got control over D. When we have any such situation like this, do we call it as control, but it means unilateral control. Unilateral control means one entity has got control over another entity, or only one entity has got control over another entity. That is called as unilateral control. Fine. Clear? Whenever there will be control, so for the purposes of understanding of control, what do we refer? Ind AS 110. And for the purposes of accounting of consolidated financial statements, which standard do we refer? Once again, we'll refer Ind AS 110. Whenever any acquisition will take place, we will always have to check first of all whether it's unilateral control or not. First checking will be for unilateral control or not. Clear? All of you? Okay. Now, let's suppose P acquired D Limited, and because of this acquisition, P got joint control over D. It's not unilateral control, it's joint control over D. P got joint control over D. Okay. Now, because of this joint control over D, what will P be called as? P will be called as investor and D will become joint venture or joint operation for P Limited. For the purposes of this joint control, instead of Ind AS 110, we will now refer Ind AS 111. And for the purposes of consolidation, we will have to refer Ind AS 111 and Ind AS 28. Because in such a case, either equity method may have to be considered for joint venture or proportionate consolidation may have to be considered for joint operation. Now, what is the joint venture? What is the joint operation? What is the joint control? All of these things we'll have to understand one by one. And we'll discuss all of these things in more detail as we move further. I'm just telling you the flow. So first of all, we check whether it's unilateral control or not, whenever any investment is made. If not, then we'll have to check whether it's joint control or not. If, let's suppose, we say joint control is also missing, it's not joint control. Okay, so this is first. Second, we found joint control is also missing. Then what is the next step? Next step is to check whether P Limited, after its acquisition of D Limited, got significant influence over D Limited or not. I'm saying whether due to its acquisition of D Limited, P Limited got significant influence over D Limited or not. If yes, then in such a case, D Limited will become associate of P Limited. And now there is no control of P over D, neither unilateral nor joint. It's only significant influence. For which standard do we refer? Ind AS 28. And which standard do we refer for consolidation accounting? Ind AS 28. So this comes third in hierarchy. When these two were not found, then we evaluated whether it's significant influence or not. Okay. Let's suppose E Limited acquired D Limited, but significant influence was also not found. So we are saying third we checked whether there is significant influence. Or not. And we found significant influence is also missing. Now what do we do? Now where do we go? Because now it is not even an associate. But acquisition has happened. P Limited has got stake in D Limited. Now, which standard do we refer? Where do we go? What do we call this investment in D Limited as? This will be called as normal investment, means not in the nature of control or subsidiary, not in the nature of joint control or JV, not in the nature of significant influence or associate. This will be called as any other investment. Other means other than these three, and for which the relevant standard will be the one on which we have spent considerable time. That is Ind AS 109. And for which no consolidation requirement is there. It will be accounted for in the standalone financial statements only. Okay, clear? Now this flow that I have discussed with you has to be always kept in the same manner. I am repeating my point. Whenever you will see any acquisition taking place, you will have to first of all check whether investor has got control or not. Means unilateral control or not. If you say no, then you cannot go to check whether it's significant influence or not. No. Then you will have to check whether it's joint control or not. If the joint control is also missing, then you will have to check whether it's significant influence or not. If that is missing, then by default it will come under this category. Okay, yeah. With this, one question which should have come to your mind, and I'm sure you might be thinking about it. So does it mean that whenever there will be an acquisition, we'll have to just always evaluate these three things? That means we cannot go to straight away Ind AS 109. Means whenever any question will come for Ind AS 109, we'll have to consider these three aspects also. Yeah? Is it bothering you now or not? Is this question coming to your mind or not? And you may be thinking, but sir, we have covered financial instruments in totality and nowhere we discuss about these points. So how come this point is coming now? Is it something in addition to what we covered? So is this thought coming to your mind? Yes or no? Now in this case, what you need to understand is the practical aspect first of all. So practically, whenever you will see any such acquisition taking place, this flow will have to be ensured. You will have to check like this. I'm saying practically. But for the purposes of your exam, it's not necessary that you'll have to go through this entire flow. Many a times the question will be straightforward. And once you will be done with all of these concepts, even though I'm saying you'll have to check this first, this first, this first, this first, you will be so familiar, you will be so clear in terms of your assessment that even though you evaluate these two or you don't evaluate these two, it will not matter to you. Because you will be sure that these two will not be there, and that's why it has to be significant difference. Or maybe these three are not there, so that's why it has to be any other investment. And that will come with practice. That will come over time. Fine? Yeah. And in the exam, many times the question will also be very straightforward. So you will not have to worry so much about it. But yes, some sort of consideration around this flow should always be given by you. Because in practical life, you will always have to do this. Okay? Clear? All of you? So any questions in case you have, please let me know. In case you have any questions, please let me know. Tell me. I'm waiting for your questions. Huh? Any questions, any doubts? Okay, so let's move further. So now we are starting with Ind AS 110. Okay. So that means throughout the course of our discussion over the next few sessions will be towards unilateral control only. This, I would say, also happens to be very, very important chapter for you. Financial instruments, business combination, consolidation. For the purposes of your examination, you should mark as very important chapters. Yeah, you can definitely expect some questions from these chapters. You can definitely expect them. Means questions are certain to be picked up from these chapters. So theoretically, these are important. From examination perspective, these are important. Secondly, even if you look at your practical life, means whenever you'll have to apply any of these standards, wherever financial statements will be prepared, even there, all of these standards which we are discussing will be very important. Financial instruments, we know, will cover 60 to 70% of the financial statements. So that's why they are important. Consolidation, again, very important area. Business combination, very important area. So such is the importance of these chapters which you should understand and mark for the purposes of your examination. Now coming back to Ind AS 110. First of all, one important point under Ind AS is about the preparation of CFS, which is mandatory. Under Ind AS, consolidated financial statements is mandatory. And what do we mean by mandatory? Means whenever any investor will have either JV or associate or subsidiary. Now it may be only one or all of these three, or maybe 3 JVs, 2 associates, 1 subsidiary, or maybe 3 associates, 2 associates. Means in any of these situations, preparation of consolidated financial statements is mandatory. It cannot be avoided. Clear? Yeah. However, there is an exemption which is available under this standard in AS 110. In which case, this investor may not be required to prepare consolidated financial statements, and I'm saying may not, means it's not an exception, means it's not that this investor will not be required. If he chooses that he doesn't want to prepare CFS, then such an option can be availed by him. Otherwise, preparation of CFS is mandatory under Ind AS. So let's understand what does this exception require. You can go to page number 14.6. There's an exemption which is available. Section 3.2. An exemption is available. So what does it say? A parent entity that meets all of the following conditions need not present, means it's an option available to it. So with the help of this example, I think you should get more clarity around it. So these are 4 entities. Let's suppose A holds 90%, B holds 100%, C holds, say, 95%. Or in simple terms, I can say A has got control over B, B has got control over C, and C has got control over D. Okay. Now the question that arises is that C will be required to prepare CFS. And in its CFS, what will C do? C will include C plus B. It's mandatory. But due to this exemption which is available, if C wants, C may not prepare CFS. Okay. Due to this exemption, I'm saying if C wants, C may not prepare CFS, means one option is available. Now, because of this option, let's understand what are the requirements which will have to be fulfilled by C. Yeah. First, C should be wholly owned or partly owned subsidiary of B, and all the owners of C are informed and they do not object to C not preparing CFS. Means above C, there should be an investor who has got control over C, and C should have taken permission of its owners. Who are the owners of C? B, or you can say A. Means their owners should have permitted that if C doesn't want to prepare CFS, it's okay. So first is owner's consent. And this is second, it should be subsidiary of, it should also be a subsidiary. Okay. Third, debt or equity instruments of C are not traded in public market. Third, C has not filed or not in the process of filing for listing. Means C should not be a listed company and should not be in the process of getting listed. Should not be a listed company. Fourth, entities C's ultimate or intermediate parent company means either A or B prepares financial statements which are available in public domain, and they are prepared as per Ind AS, in which subsidiaries are consolidated or are measured at fair value through P&L in accordance with Ind AS 110. Either A or B produce CFS as per Ind AS 110. Okay. If all of these conditions are fulfilled, then option is available to C of not preparing its CFS. We are not saying CFS of B or CFS of A. No. We are talking about CFS of C. All of you clear on this exemption? Are you clear about this exemption now? Yes, quickly. Clear? Any questions, any doubts in case you have on this exception? Are you clear on this? Ambika is asking, sir, the consent of A is also necessary? Of course, yes. Because ultimately C is controlled by A. So when it comes to the of B is also under the consent of A. So if B will approve anything, that is only possible after the approval of A. So by default, whose consent is required? It's actually A only. Clear? Okay, so what we can do is, we can look at one illustration. Illustration number 2. This is page number 14.8. So you can mark homework as illustration number 1. $14.7. And we'll start with illustration number 2. This is on page number 14.8. Okay. So we are given scenario A, B, in which case a structure is available of group headed by company A. Below A, there are two companies B and C, and below C, there's a company X. I'm talking about scenario A. Company A is listed in India and prepares CFS as per Ind AS. Company C is unlisted and it is not in the process of getting listed. 60% of equity share capital of C is held by A and balance 40% is held by some other investors, not within this group. Company A does not object to C if C does not prepare consolidated financial statements, whether C is required to prepare CFS as per Ind AS 110. Scenario B. Assume the same facts as per scenario A, except the fact that balance 40% is held by B. In this situation, whether C Limited is required to inform its other owner B Limited of its intention to not prepare CFS. Yeah. So these are two situations on the basis of which two questions you need to answer. So what we will do is we'll take a break now for 10 minutes. In the meantime, I would suggest if you can just solve this question and start sharing your answers. If you don't want, because you may be thinking, sir, why you are asking us to do this within the break. So it's okay if you don't want to do this, but some of you who are not really taking any breaks, you can just solve this and share your answers with me. Yeah. Kostab is asking, sir, what type of companies may choose this type of exemption in real life, practically? See, practically, it will be generally about private companies who don't really want to prepare the consolidated financial statements just to avoid any sort of complexity of preparing this. Okay, because for listed companies, this cannot be avoided. Yeah, clear? Okay, so you can now take a break, or if you want, you can just keep answering this about this illustration number 2. And after the break, we'll start with the solution of this illustration. All right? Yeah. Jay? Hi, welcome back. So we can now continue with our discussion. I've received a couple of responses on this illustration number 2. So let's go with scenario number A. Ambika is saying for scenario number 1, if the balance 40% also give consent, then this company C will be exempt from preparing the CFS. Anjali is saying, no sir, company C is not required to prepare CFS, and it is because this is not listed, it's not getting listed, and A does not object for the same because A is the parent company. Okay, so therefore C is not required to prepare CFS. I think Anjali has commented about both the scenarios. So talking about scenario number A first of all, let's talk about its solution. If you look at C, it's a partly owned subsidiary of A. In such a case, C should inform other 40% equity shareholders about this fact that C is not preparing consolidated financial statements. And if they do not object, only then C can avail the exemption from preparing the consolidated financial statements. Okay, yeah. Moving on to scenario number 2, scenario B. Ambika is saying, sir, in scenario number 2, B is ultimately held by A. So consent of B is not necessary because ultimately it's controlled by A only. Okay. Now let's come back to scenario number B. In this scenario, C effectively becomes 100% subsidiary of A. 60% control is direct and 40% control is indirect. Yeah, if you look at the situation. Therefore, in this situation, C will not be required to separately inform B because that is by default there. By default, because it has obtained the consent of ultimate parent, that means A. That's why I can just go ahead with this and may not prepare the consolidated financial statements if there is no objection of A on this. Okay, clear on this? So this was about an exemption from not preparing the consolidated financial statements. Other than that, Ind AS 10110 also gives one more exemption, and that is in respect of investment entities. We'll talk about investment entities slightly later as we move further in terms of our discussion on Ind AS 110. But because you will be noting down the exemptions, you can just note down one more type of entity, investment entities. So under exemptions, exemption number A is in respect of these 4 conditions. So if a company fulfills all these 4 conditions, then the exemption of not preparing CFS is available. Okay. Another exemption from not preparing CFS is available to investment entities. Means if a company is an investment company, investment entity, it will not be required to prepare CFS. Okay. Yeah. Now On this investment entity, you can just give the reference. You can give the reference that this has been discussed subsequently. Means this has been discussed in the later part of this discussion on Ind AS 110. All right, yeah. So with this, what will happen? All of your exemptions will be noted down at one place. Now comes the most significant part of this chapter. Significant, I would say. Majority of this chapter, of this discussion on Ind AS 110 will be on assessment of control. As we have discussed, that for the purposes of consolidation as a subsidiary, or I mean to say, if we have to call investee as our subsidiary, then the investor should establish control, and that control should be in the nature of unilateral control over that investee. Now, how do we get control over that investee is explained through certain criteria in this standard. When we discussed business combination, if you can go back to the first session and if you can just recollect, maybe you would have noted down various points. For a business combination, we said two conditions were mandatory. One, there must be a business. Second, investor should get control over the investee. And for the purposes of control, we briefly discussed the criteria, but we didn't get into detail of those criteria because we said that when we'll cover Ind AS 110, we'll get into detail of those criteria. So now we are talking about those criteria on the basis of which we can say investor has got control over the investor. Can any of you tell me those three criteria? If you remember, there were certain criteria. There were three criteria on the basis of which one can say whether investor has control over the investee or not. So without referring to the study material, can you please let me know what were those criteria? We have already discussed about them. Not in detail, but yes, of course, briefly we discussed all the points. So can you now tell me what were those points? Quickly, I'm waiting for a response. What were those points that we discussed around assessment of control? Yes. Tell me, what were those points around assessment of control? Okay, Ambika Singh sir, first point was influence over variable returns. Good. What were the other points? Anjali is saying control the profits of the investee was one of the criteria. Okay, very good. Ambika is saying there was another criteria, sir, exposure to variable returns. Okay, great. And what was the third criteria? So two you have told me. What was the third criteria? What was the third criteria? Quickly. Third criteria. Pujita is saying, so third criteria was to have power over the investee. And Kaustubh has given all the three criteria. Yeah, very good. So let's get into detail of all of these criteria. Now, each and every criteria will have to be analyzed in detail. And this is what you will do practically also. In your practical life, you'll have to do this. Each and every criteria will have various points to be considered. So you'll have to get deep down into each and every criteria to understand whether control exists or not. And what are those three criteria? First, there should be power over the investor. Second, investors should be exposed to variable returns of the investor. Third, through its power, investors should be able to influence the variable returns of the investor. If all three conditions are fulfilled, it's not one of them. If all three conditions are fulfilled, then we say that it's a case of unilateral control. So if you want, you can just refer to page number 4.10 of the study material. Okay, yeah. Now we will begin with the first criteria and we'll get into details of this first criteria. Power over the investor. How can the investor get power over the investor? Now, if you look at the investee, what is an investee? Investee is a company. We are analyzing this for a company, correct? Or you can say it's a business. Now, if the business has to be run, it will include various activities which require decision making, which require certain decision making. The question that will arise is that in respect of all of those activities of an entity, who is taking the decisions or who has the power, who has the authority to take such decisions? The person who will have the authority or the persons who will have the authority in respect of decision making for that particular entity will be considered to be the one who are or who is controlling that entity. Correct? So in simple terms, if we have to understand power, what does power mean? Power means somebody who can direct. Operating financial policies somebody who can direct such policies of a company. Means who will give directions, who will not give advice. Let's suppose there are two parties, C and D. C directs D in respect of D's decision making. C doesn't advise D. It's the direction. Direction means instruction that D will have to do this, what C is saying. That is considered to be a direction, or you can say having power over D. Clear? Yeah. But this is a very broad term which I have used. Now a question arises that how can we be in a situation to direct this? For this, we will have to consider various factors. So the first criteria of control evaluation comes with certain aspects. One, that is the right of the investor. What are the existing rights of the investor which give ability to the investor to direct the activities of the investee? So we can say rights of the investor to direct in respect of activities. If we are able to prove that investor has got the rights using which he can direct the activities of an entity, then our job is done. Then our job is done. Now, in respect of directing the activities, first of all, we should understand what are the activities that are being discussed. Because accordingly, we can check whether rights are there or not in respect of directing those activities. So let's think of a business. In a business, on a daily basis, hundreds of activities may be going on. Correct? Yeah. And let's think of an investor now and an investee. Okay, so I'll bring in investor and an investee. Let's suppose C is the investor, or you can say C Limited is the investor, and we are talking about D Limited, which is the investee. Now D Limited is a company and C Limited is also a company. C Limited is also a company. Now for a company which is having a business, hundreds of activities are there on a day-to-day basis. Now let's think about the activities on a daily basis. Daily basis, company will need some funds. Yeah. Daily basis, company will be required to make some payments. Daily basis, company may be hiring some employees. And daily means regularly. In fact, some of the companies actually hire on daily basis. On a daily basis, company may be firing some of the employees, or you can say employees are leaving. Employee leaving an organization. Okay. On a daily basis, a company would be incurring various expenses. And these expenses could again be of various types. Maybe some expenditure is incurred on printing and stationery, some expenditure is incurred on staff welfare, some expenditure is incurred, let's suppose, for some miscellaneous expenses. Some expenditure is incurred, let's suppose, for some, say, conveyance or for traveling. Yeah. And on a daily basis, sales will be going on. So sales invoices are getting generated. Purchase invoices are getting generated. Discussions are going on with various parties. Correct. Now, when it comes to C Limited, and when it comes to directing the activities or having the right or the power to direct towards those activities, let's understand the meaning now. Now, what are we trying to understand? Are we trying to check that whether C will be able to direct each and every activity which this company will be able to, which this company will be doing? Means if today any expenditure on printing and stationery has to be made, if today any employee has to be hired, say an employee at a very lower level, or maybe a trainee has to be hired who will be paid only rupees 10,000 per month. Okay, only. So all in all, in a year, he will be paid 1,20,000 only. Say a check has to be issued and this is required to be signed by a person. So does it mean that every day for all of these 100 types of activities, consent of C Limited will be required and that will mean as direction? The answer is no, because this is impossible. If C will be required to do this, C will say, forget me, I don't want direction over this company. I don't want power over this company, because otherwise what will C do? C will not do anything but focus only on these things, which is not practically possible. Correct? Yes or no? Yeah. So for this purpose, standard requires activities to be broken into two parts. Standard says that for an investor, it's not possible to control each and every activity on a daily basis. It would become impossible. So that's why standard says one is activities which take place on a day-to-day basis. Day-to-day activities, or you can say day-to-day operations. When it comes to control, control doesn't mean that C should be having control over these day-to-day operations. No. Day-to-day operations are okay. They can be executed at the direction of any person like CFO, CEO, finance head, departmental head, or the managing director. Okay. Other than day-to-day activities or other than day-to-day operations, there could be various activities which are critical for functioning of this organization. Critical activities like financing, budgeting, hiring of KMP. Hiring is there, but of KMP. Who is KMP? Key managerial personnel. For example, if any director is required to be appointed, if CFO is required to be hired, if CEO is required to be hired. Yeah. Capital budgeting means any capital expenditure of a significant amount has to be made. So this company D Limited has a turnover of 400 crores. So a threshold can be built that any expenditure or any activity which is over and above 10 crore, that will become critical activity. And other activities which are below 10 crore, those have been assigned to various KMPs. Now, who will govern these day-to-day operations of the company? KMPs. In respect of day-to-day operations, C Limited will not have any say. C Limited will not have any direction. Who will have the directions? KMP, like CFO, CEO, finance head, managing director, departmental head, sales head, marketing head. All of these persons will control these activities. But ultimately, who will appoint these persons? Board of directors. correct? And whose consent will be required for appointment of those KMPs? C Limited. So if CFO, if CEO, if MD is the person who is appointed by C, then in a way C is indirectly controlling the day-to-day operations or not? Yes, clear? Yeah. So now the first question that we wanted to understand was about the activities. That when it comes to the activities, what all activities should be covered for or over which direction of C Limited should be there to establish power over D Limited. So we can say those are critical activities. Those are not day-to-day operations. Okay. Yeah. Now these critical activities are called by the standard with a different name. Standard says critical activities means relevant activities. Means if the investor will have control, if the investor will be able to direct the relevant activities, then it will be understood as if the investor has got control over the investee or has got power over the investor. So he is not supposed to have power over these activities. No, not required. He needs to focus only on the relevant activities. So that's why it will be important for us to understand what are the relevant activities, because only when we make out as to what will be the relevant activity, we will be able to establish this power, otherwise not. Correct? Yeah. Okay. Yeah. So let's move on to illustration number 4 now on page 14.12. Illustration 4. Okay, to discuss about the relevant activities. So we'll go one by one. So far we have been discussing about activities only. And now we are discussing how to determine the relevant activities, which we have understood that some of these critical activities which affect the functioning of the company, which affect the variable returns of the company or the investee, are considered to be the relevant activities. Okay, you can say the critical activities in a way. Okay. A Limited is an asset manager of a venture capital fund, that is Fund X. Out of the total outstanding units of the fund, 10% units are held by A Limited and balance 90% units are held by other investors. Majority of the unit holders of the fund have right to appoint a committee which will manage day-to-day administrative activities of the fund. Okay, so a committee will be appointed which will manage day-to-day administrative activities. And who will appoint that committee? Majority of the unit holders. A doesn't have the majority of the units. Okay, A has got 10% of the units. However, the decisions related to investments, disinvestments, to be done by this fund, venture capital fund, is taken by A Limited. Based on the above, we need to comment on two things. We need to comment on two things. So my first question to you, in this situation, what will be the relevant activities? Number 2, who has got power in this case? A or other unit holders? So I have 2 questions for you. Quickly, can you please answer this without looking at the solution, please? Huh? Yes, quickly, you can tell me. If you can answer these 2 questions quickly, please. Ambika is saying relevant activity will be the investment related decisions. Okay. What about others? And what about answer to question number 2? Who will have power over this fund? Yes, quickly, all of you. Please try to answer this. Cost of saying a relevant activity is making investments or disinvestments by the fund. Great. And therefore, he's saying power is with A Limited. Because what is the relevant activity? The relevant activity is investment or disinvestment, and that is controlled by only A and not the other unit holders. Anyone else wants to attempt this? Any more responses? Okay, Ambika is saying A has the power. Very good. Anjali is saying majority of the shareholders have got the power. All right. Now in this question, if you'll see, activities have been segregated for your purposes already. One set of activity which is controlled, over which final say lies, is with whom? Majority unit holders. And what are those activities? Day-to-day administrative activities. For our purposes, are the day-to-day administrative activities relevant? No. Because somebody will have to run those activities, and who is that? Those are other unit holders. For us, what is the relevant activity? The critical activity. For a fund, what is the critical activity? Making investments, making disinvestments. These are the critical activities, relevant activities. And who is having power over these activities? So the question says, in relation to these activities, decisions are taken solely by A. A is the one who is taking the decisions. A is the one who is directing these activities completely, without any say from other unit holders. So that's why who will be considered to have control or power over this fund? A Limited, because he is able to direct the relevant activities. Clear? Clear on this? Okay. Let's move on to illustration number 3 now. All of you, please move on to illustration number 3. If you just try to understand some of these concepts, you will find that this part of Ind AS 110 will be very, very interesting. Okay, but you will have to understand the concept. If you don't understand the concept, let me just tell you, you will not be able to mug up any of the thing, because in this entire part, there's nothing which you can just cram or learn or mug up. So the only option that is available to you is to understand the concept. So that's why I'm telling you that if you face any query, any doubts on any of these concepts, please keep asking me. Okay. Illustration number 3 now. A and B have formed a new entity, AB Limited, for constructing and selling a scheme of residential units, which will consist of 100 units. Construction of the residential units will be done by A Limited, and it will take all the necessary decision related to the construction activity. B Limited will do the marketing and selling related activities for the units, and it will take all the necessary decisions related to marketing and selling. Based on above, who has the power over AB Limited? So we have investee in the form of AB, and we have got two investors, A and B. And we have also discussed about certain activities. Now we need to comment who has got power over the investee, AB Limited. Tell me, over to you now. Yes, quickly, all of you tell me. Ambika is saying that it seems both A and B. I think some part of your answer is missing. You need to say both A and B have got control. So if they will have control, if two parties will have control, then it will not remain unilateral control. It will become joint control. So do you mean to say it's a joint control situation? Tell me. Cost of this since both the activities are relevant, therefore both A and B will have control. So once again you are saying it's a joint control, is it? So Ambika and Kaustav have actually given their response as joint control. What about others? What about others? Please try to answer this now. Is it a joint control situation? Anjali is saying, sir, A and B both have power because both construction and marketing are the relevant activities. Okay, let's go to the solution. In this case, both A and B have right to unilaterally direct different relevant activities. Here, investors shall determine which activity can most significantly affect the returns of the investee, and the investor having ability to direct those activities would be considered to have power over the investor. Hence, if the investors conclude that construction related activities would most significantly affect the returns of AB Limited, then A would be said to have power over AB. If it is concluded that marketing and selling related activities would most significantly affect the returns of AB, then B would be said to have power over AB Limited. And it can also move into this way. Let's suppose up to a period of time only construction is taking place. Let's suppose this company is dealing into only one project for which construction has been going on, and the plan of the company is to market and sell once the construction is completed. Okay. In such a case, till the time construction is not completed, what is the activity that will be the relevant activity? Construction. And who is taking decisions around it? A. So that means up to this period of time, who will have control over this entity A. After this construction is completed, the only thing that remains will be marketing and selling, which will be as per the directions of B. Therefore, after this date, control will shift from A to B. In the given example, that means illustration number 3, this type of situation will not arise. Why? Because in any real estate company, construction and marketing will go hand in hand. These will be happening simultaneously. Company will not wait for this to be completed to start marketing. Okay, yeah. But I was just trying to explain you that in case there is a sequence of events that moves in a sequential manner and not in a simultaneous manner, even then we may have a situation of different types of relevant activities, and in such a case, two different investors may control that entity unilaterally at different points of time. But in the current situation, right now, if we are able to comment that this one is more significant, or if this one is more significant, then A or B would become the investor having unilateral control. If this segregation is not possible, then we will have to consider this to be a situation of joint control, which will generally happen. Okay. Yeah, then it will no longer remain unilateral control. Clear? And for joint control, we will have to go to Ind AS 110 to analyze it further, if that is established. Okay, clear? So we were discussing about two things. One was the rights of investor. To direct the relevant activities. So I will now combine these two. Direct relevant activities. Okay. So we have understood what do we mean by directing the relevant activities, because we have first of all understood the relevant activities. Now comes the part wherein we need to understand the rights. That what do we mean by rights? Or in what situation we will be able to say that investor will have right to direct the relevant activities. Rights can be once again be divided into two categories. One, which are currently exercisable, and the others which are not exercisable currently. Okay. The rights which can be exercised or which are exercisable currently are called as substantive rights. Rights which cannot be exercised currently are called as non-substantive rights. Okay. For the purposes of having power over the industry, it is important that the investor is able to direct the relevant activities now. That means he should have such a right which are currently exercisable. It should not happen that he will get some right in future through which he will be in a position to direct the relevant activities in future. No. What matters is the present, current scenario. So that's why whenever we will have to check direction of the relevant activities, we also need to check whether the rights are currently exercisable or not, or in technical terms, whether the rights are substantive rights or not. Now a question may arise, sir, how do we find out that whether the rights are currently exercisable or not? Yes or no? Yes. So let's understand this. See, there are two companies, A, which is having, say, 30% stake in company C. Okay. And 70% stake in this company is by other shareholders. Fine. Yeah. A has also got one instrument, convertible instrument. Means C has issued a convertible instrument. You can say convertible debt, convertible preference share, convertible debenture, say any sort of warrant, which when converted into equity will give voting rights to A in such a manner that A will start getting control over C. So if you look at the current scenario, in the current scenario, who is directing, who is having the majority rights? It's others, not A. But if these convertible instruments are converted into equity by A, which is possible after 6 months. Then activities of C means the relevant activities of C will start getting controlled by A, or you can say directions in relation to those activities will be from A, but that will be possible after 6 months only. Okay, and we are on today's date, and next month a board meeting has to happen. Next month board meeting is planned. In that board meeting, various critical decisions will have to be taken. Now in this situation, can we say that A has got rights to direct the relevant activities? The answer is no. Why? Because A's rights are there through which he can direct the relevant activities of C, but those rights will come to A after 6 months. And today, when the decision making has to happen, when the decision making is taking place, he is not having any say. He is not having control. He is not having any power. Understood? Yeah. So A's rights are not currently exercisable. But let's suppose convertible instruments are such that A can convert them into equity at any point of time, as per his discretion. So the instrument says instrument will get converted into equity after 6 months, but up to 6 months also, if A wants, A can convert them into equity. Okay. In such a case, can we say that A's rights are currently exercisable? Now the answer is yes. Because if the board meeting has to happen, let's suppose after 10 days, after 15 days, A has the ability to convert this instrument into equity and get majority rights, majority power. So then A's rights will be considered to be currently exercisable. Clear? Clear on this? Now for the rights to be currently exercisable, only the ability of A to convert them into equity doesn't matter. Because this type of situation again will be very common. Many a times investors may have potential voting rights, may have potential instruments, or may have convertible instruments which may give voting rights to the investor, using which investor can get power over the investor. In such a case, some more factors will have to be considered. What are those factors? First of all, we need to check whether these instruments can be converted if required today as per the terms of the contract. If we say yes, that terms of the contract allow A to convert them and get more voting powers. Number two, we also need to check that even though contractually A can do this, but whether as per the market terms, it will be beneficial for A to convert them or not. Means whether that is in the money or out of the money. whether that is in the money or out of the money. You remember these terms, in the money or out of the money? What was in the money? Beneficial. What was out of the money? Not beneficial. Remember? Now, only when such conversion will be in the money, A will convert. So let's suppose contractually A can convert, but if A converts that, it will not be beneficial to it. So will A convert this? No. So if that is out of the money, if it's not beneficial, then even though he has the ability to convert, can we say it will be currently exercisable? The answer is no. Even then we'll have to say it's not currently exercisable. Why? Because it's not beneficial for him to convert. He will not convert. Because it's not beneficial to him to convert. So that's why he will not convert. And if he will not convert, will he get the majority voting rights? No, he will not get the majority voting rights. And if the majority voting rights are not available to him, then who will take the decisions? Other shareholders, but not A. Correct? Yes or no? Yeah. So that's why other than currently exercisable, or you can say contractually convertible, what also matters is whether that is in the money or out of the money. Okay, clear? Yeah. Now, with this understanding, we can pick up one more illustration on page number 14.13. Illustration number 5. Yeah. An investment vehicle, that means the investing, is created and financed with a debt instrument held by an investor, and that investor is debt investor, and equity instruments held by a number of other investors. So the investee has got debt from the investor and equity instruments which are held by number of other investors. Equity tranche is designed to absorb first losses and to receive any residual interest, means return from the investee. Obviously, equity will absorb the losses and equity will also get the residual profits, because debt holder will get a fixed return in the form of interest. One of the equity investors who holds 30% of the equity is also the asset manager. So I can just put this in the form of a chart for your reference. So you can say one investee is there. So one investor, that is debt investor, has put in debt, and various other investors put in equity. So you can say I2, I3, I4, I5, I6. One of the investors who hold 30% equity, so let's suppose it holds 30%, he is also the asset manager. is also the asset manager. Investee uses its proceeds to purchase a portfolio of financial assets. So what is the investee doing? It's using its proceeds to purchase portfolio of financial assets, exposing the investee to credit risk associated with possible default of principal and interest payments. The transaction is marketed to the debt investor as an investment with minimal exposure to the credit risk associated with possible default of assets in the portfolio because of the nature of these assets and because the equity tranche is designed to absorb first losses of the investor. The returns of the investee are significantly affected by the management of investee's asset portfolio, which includes decisions about selection, acquisition, disposal of assets within the portfolio guidelines, and the management upon default of any portfolio assets. Obviously, in any portfolio, such type of things will be there. So it's all about explanation of the portfolio. That's it. All those activities are managed by asset manager until defaults reach a specified proportion of the portfolio value. So all of these activities are managed by whom? Asset manager. So he's managing this up to a stage when the defaults reach a specified proportion of the portfolio value. That is, when the value of the portfolio is such that equity tranche of the investee has been consumed. Okay. From that time, a third party trustee manages the assets. From that time, a third party trustee manages the assets according to the instructions of the debt investor. So if the default, so remember, asset manager will manage until defaults reach a specified proportion. If the defaults cross a specified proportion, a third party trustee will come in and third party trustee will manage the assets as per the instructions of this investor, debt investor. Okay. Based on the above, we need to comment who has the power over the investment vehicle. Investment vehicle means investee. Who will have the power over the investee? Yes, quickly. Can you please comment on this? Can you please start sharing your thoughts on this? Who will have the power over the investee? Quickly, over to you. Yes, in this situation, what do you think? Who will have the power over the investee? I think I missed one query of Kaustav in between. Kaustav was asking, sir, for deciding whether conversion is beneficial, that is in the money, do we have to take into account non-financial factors along with financial aspect? So what are the non-financial factors that you'll consider for deciding whether it's in the money? Because for in the money, there are only financial factors which will affect this assessment. Yes, quickly. In this example, in this illustration, can you tell me who will have the power? Quickly. Okay, Kaustav has answered this. Ambika has answered this. Ambika is saying that debt investor will have the power because default can occur at any time. So therefore, he should be considered to be having the power. Kaustav is saying, sir, up to the point where defaults do not reach specified proportion, asset manager will have the power. And once the defaults reach the specified proportion, debt investor will have the power. Okay, any more thoughts from your side on this? Anjali is saying, sir, asset manager seems to be the one who is having power over this. Quickly, any more thoughts? Any more thoughts from your side? Yes, quickly, any more thoughts from your side? No? So should we move to the solution? Now, in this situation, let's once again try to understand. First of all, we should understand the relevant activity because only then we will be able to comment on the next step. In this case, it's very, very clear that the only relevant activity is what? Managing the portfolio. Managing the portfolio is the relevant activity. Because what will be the relevant activity that mostly affects, that significantly affects the returns of the industry? So the management of the portfolio will affect the returns of the industry. There is no doubt about it. And in this case, there are two persons in a way who are managing the portfolio. Who are those two persons? Who are those two persons? First, it is the asset manager, and subsequently, it may be the debt investor. The debt investor comes in only when there's a trigger. What is that trigger? That the default reaches a specified proportion. Okay. We can also say it's a kind of protection which is available to the debt investor. Yes or no? For which we'll have a discussion in our next session. What is this protection? We can say it's a kind of protection which is made available to the debt investor that till the time that trigger is not there, he will not come in. Till that time, it will always be managed by asset manager. He will continue to manage this. But when that trigger occurs, the return of debt investor gets impacted. Till the time that trigger is not there, the return of debt investor is not impacted. So it's a kind of protection right that is made available to debt investor. I'm saying a kind of, not necessarily though. And once again, we are not getting into that protection right. But one thing is for sure, that in this case also, two parties are involved who are having directions over this relevant activity. Now, once again, we may say that this can be sequential, but unfortunately, this sequential is not possible. Why? Because this will be a continuous exercise. The portfolio may also be divided into multiple portfolios. So we cannot say this entire portfolio will be a single portfolio. They may have multiple portfolios. And one portfolio may be managed by asset manager, while the other portfolio may have reached that specified proportion wherein the investor investor might have brought in his person to manage this piece. Okay, so it may happen that at the same time, two persons are managing two portfolios of this investment vehicle. So that means sequential is not possible. And even if we do sequential, so after this investor comes in and he ensures that the default percentage goes down below that specified proportion, he will again come in and start managing the portfolio. Yeah, so it's all mixed up. It's all mixed up. So that's why in such a case, there cannot be a very clear answer. There cannot be a very clear answer. It will have to be analyzed on the basis of further facts. Currently, we cannot say all the facts are made available. So currently, we'll have to just say that it can be either of these parties, asset manager or investor debt, depending on whose activities mostly impact the returns of this portfolio. So if you go to the solution, it says asset manager and the debt investor each need to determine whether they are able to direct the activities that most significantly affect the investee's returns, including considering the purpose and design of the investee as well as each party's exposure to variability of returns. Okay. Yeah. Clear on this? Any questions, any doubts in case you have on this, please let me know. Yes, all of you, please let me know in case you have any questions, any doubts. I'm waiting for a response. Any questions, any doubts in case you have? Kaustav is asking, sir, with respect to the query, suppose a company has an option to convert debt into equity. That is again possible, but that doesn't matter because those facts will be different. So if you say that he has got his option, he has got an option to convert debt into equity on the basis of which he'll start managing the portfolio and he will replace asset manager. So if that becomes the case, then of course we have to check whether that is currently exercisable or not. And if that is currently exercisable, then he will get power. Ambika is saying, but sir, a debt investor has in the money, that is beneficial interest. So that is fine. So we are not challenging that at all. Anjali is saying, sir, asset manager has got the substantive rights. Debt investor doesn't have the substantive rights. And Pujita was saying, so till specified proportion, it's the asset manager. Beyond that, debt investor. Yeah. So I think you answered these questions. So with this, what we can do is, we can just conclude our discussion now. We can end this session now. In the next session, we'll continue from this. And as you would have understood, because it's a sequence of steps which will have to go on in the next session. So that's why it's very, very important that you come after revision of these concepts. Otherwise, it may become problematic for you. Okay, clear? Yeah. So with this, I would like to thank all of you once again for your time and for your wonderful participation. Thanks so much.